The following script was written, verified, and approved by compliance professionals. An investor is any individual or entity committing capital to a financial asset expecting a return through income or appreciation while accepting the inherent market risk. Every financial regulation, including the Acts of 1933 and 1940, exists to ensure investors have accurate information and that markets operate with integrity and transparency. Investors exist across a spectrum, from retail individuals to sovereign wealth funds. Identifying where an investor falls is essential for applying the correct regulatory framework and protection standards. Accredited investors meet Rule 501 criteria: annual income over $200,000 or $300,000 jointly, or a net worth exceeding $1 million. Qualified purchasers occupy a higher tier, defined as individuals owning $5 million in investments or entities owning at least $25 million in total investment assets. Qualified institutional buyers are institutions defined under Rule 144A that own and invest at least $100 million in securities. These thresholds serve as proxies for sophistication, justifying reduced protection in private offerings. These investors possess the resources to evaluate complex opportunities and the capacity to bear losses. Investors access markets through distinct channels. Full-service broker-dealers offer recommendations under Regulation Best Interest, while registered investment advisors operate under the fiduciary duty of the 1940 Act. This fiduciary duty requires acting in the client's best interest. Alternatively, self-directed accounts allow investors to execute their own decisions without advisory services, receiving only standard anti-fraud protections. Employer-sponsored retirement plans, governed by ERISA, provide defined investment options. The plan's investment committee is responsible for selecting and monitoring options in accordance with their fiduciary obligations. Every investor is protected by Rule 10b-5, which prohibits material misstatements. This gives investors a federal legal remedy against fraud in any securities transaction. SIPC protects investors against asset loss at insolvent broker-dealers, covering up to $500,000. Note that SIPC covers custody risk, not market losses. Objectives drive strategy. Capital preservation prioritizes protecting wealth, while income generation prioritizes regular distributions. These are common for investors with short time horizons or retired status. Capital growth prioritizes long-run appreciation via equities. Total return maximizes the combination of income and appreciation, balancing components to drive wealth accumulation over time. The advisor relationship is governed by duty of care and loyalty. Advisors must understand a client's profile, risk tolerance, and circumstances before making tailored recommendations. The duty of loyalty requires placing investor interests above the advisor's own. This includes disclosing all material conflicts through Form ADV to ensure absolute transparency. In summary, understanding investor classifications, objectives, and fiduciary obligations is the foundation of the Series 65. Mastering these frameworks ensures you are prepared to serve finance's foundational participants. Knowledge gets you qualified. Visibility gets you hired. Explore financialregulationcourses.com for professional memberships that combine verified profiles and career tools to help professionals stand out.